Welcome. It's Tax Tip Tuesday with me, Christine Walters, on May 2nd, the day after the 2023 tax season unofficially closed. So, today's topic, snowbirds who spend a lot of time in the US can be liable for major taxes. So, as a result of an information sharing agreement between the US's IRS, Internal Revenue Agency, and Canada's Canada Revenue Agency almost a decade ago, a growing number of Canadians have been hit with unexpected US tax bills, penalties, and occasionally even worse than that. So the agreement was passed in 2014 and it's designed to collect untapped tax revenue from Canadians who spend extended amounts of time in the US each year by enacting the Canada United States Enhanced Tax Information Exchange Agreement Implementation Act. So there's a mouthful for you if you want to Google it, for those of you snowbirds who spend some time down in the States every year. So since the CRA and the IRS have cozied up almost a decade ago, many cross-border finance specialists advise that many of us tax specialists and accountants on both sides of the border, either side of the border, don't possess the qualifications to properly file taxes on behalf of these cross-border clients. So a lot of people who use accountants assume that their accountant just knows everything that's going on, but in reality, almost anybody can call themselves a tax person. So I had written this in an email to somebody a week or so ago. Those people who work as tax experts at H&R Block, they only have to take like a 55, 60-hour course in order to do that job and start doing tax returns for people. So on one end of the spectrum, there's very, very little education that could be taken to classify yourself as a tax expert. Anyway, so Alexa, dismiss. And there's just proof that we are actually live because Alexa was telling me it's 3:00, time to go live. So just like doctors don't do everything, us accountants, we generally specialize in certain areas. And a big part of this is because the Canada Tax Act is over 3,200 pages long, plus more once you factor in the rules, regulations, and interpretations. And the IRS tax code is over 6,800 pages long, plus more for their rules and regulations and interpretations, never mind the individual state tax codes or acts. So it could be quite overwhelming. So back to the snowbirds. So through a complex substantial presence formula, that this tax agreement attempts to determine what a Canadian's tax status is in the US. So snowbirds can be taxed in the USA if they spend more than 182 days in the US based on a 3-year rolling average. So there is a myth that the 183 days, that's 6 months, resets every year. That's not the case. It doesn't reset. Snowbirds, on average, should only spend about 4 months a year in the US to prevent themselves falling victim to having to pay into US taxes. So the reason why I say it's about 4 months is because it's a rolling average. So in the current year, you would count 100% of your days. So if you're there for 50 days, you count 50 days. Last year, your previous year, you count your days at 1/3. So if you were there for 60 days, you would add another 20 days. And then in 2 years ago, you were there for 60 days as well. You would then count the days at 1/6, so 10 days. So in the United States, Canadians are not considered substantially present if they have been in country less than 183 days, based on that rolling average. So when you do that rolling average over the course of 3 years, really the maximum amount of time that a snowbird can spend in the US without triggering US taxes is about 4 months, give or take a day or two. So it also in the US, if you spend too much time there without proper immigration status, you could be considered illegal. And if you're caught, you could also be permanently banned from entering the US in the future. There's also some other unwanted or undesirable consequences on both sides of the border, such as having US tax implications on your income from anywhere in the world. So if you receive money from other parts of the world, it could also be taxed in the US. The CRA may impose a departure tax on you, on a resident, if they cease to be considered a resident of Canada for tax purposes. So Canada tax people based on residency, not citizenship. So if you live in Canada for tax purposes, you pay tax in Canada. If you are also an American citizen, you would also file and potentially pay taxes in the US based off of your US citizenship. So that departure tax is tax that's calculated based on any gains on the deemed disposition of your assets or property. So if you own a house or stock portfolio in Canada held in a Canadian brokerage account and you're deemed a non-resident for some reason, you could owe taxes on that, and it could be quite substantial. And then the last one is, of course, losing provincial health care. Each of the provinces has a set amount of time or days that you can be outside of your province before you lose access to provincial health care and have to requalify for it. So these kind of tax problems can result in you paying more taxes in the US than you actually pay in Canada. And more importantly, if you die and you're in this type of situation, you or your family, your estate could face US estate and or inheritance taxes. So we don't have any inheritance taxes here in Canada. We do have some probate fees and that sort of thing, depending on what province you're in, but any final disposition of a deceased person's assets is all taken care of on their last tax return. There's no inheritance or estate taxes like there is in the US. So this agreement that I mentioned, that long ass name that I set up at the top, has affected many clients who have cross-border connections. A lot of those clients have learned the lesson the hard way when they're trying to transfer or sell their property or assets. So for example, during the 2008 real estate crash, when oil prices pushed the Canadian dollar to more than the US dollar, we were at par, a little bit better for a while. A lot of Canadians started buying US properties, and a lot of them made them into, part-time rental properties. So many people who bought around then, whether it was in Arizona or Florida or California or whatnot, their names, their information is on the radar with the IRS. That's what this act did, was it made it so CRA and the IRS could talk very closely as it relates to this rental income. So if you've got a property down there, it's on Airbnb, that information is being reported to the IRS and could result in some not so nice consequences for some people. So the kind of exemption to that is if you are a snowbird who doesn't rent out or intend to rent out your property, then generally speaking, no information is shared because you're not generating any income down there. But again, you still have the rolling average to worry about for the number of days that you're in country. So before you end up paying any taxes or dealing with any of these kind of consequences, you should consult with a tax professional, preferably one who's experienced on both sides of the borders, or who is experienced on one side of the border but has a link connection to somebody on the other side of the border, and in the state that your property or that you're visiting is, because every state is different and unique. So make sure that you consult with tax professionals to better understand the implications before you travel to the States for an extended period, and definitely before you buy any property in the US. Yeah, so I hope you enjoyed this week's Tax Tips Tuesday with me, Christine. Come back next week for another tip. And I hope you enjoy the rest of your week. And for those of you that are here in Calgary, please get outside. It's 22 degrees. I just put my cats out and I'm about to go out and join them in a little bit. Talk to you soon.